Welcome to Geared for Growth. I'm your host, Mike Mortlock, Managing Director of MCG Quantity Surveyors. I'm thrilled to announce this week's episode is with Mr. Episode 1 and 100, our first ever guest, Cate Bakos. I reached out to him as a fan of his work many years ago, back in 2017 when I started the podcast, and we've since become friends and had him on the show quite a number of times. But today I wanted to corner him to get a bit of a read on the economy, inflation, when he expects interest rate cuts to happen. We talk about vacancies, we talk about international migration. He gives us an insight into the economy. We talk about Perth, of course, a very topical location, and whether he thinks that still has some legs to run, and just the general outlook for property and the economy in the next few years. It's an awesome interview with Pete, who's always very eloquent and erudite in his responses. He's a man that has his head in the game on a daily basis, and I couldn't recommend his blog highly enough for anyone interested in the economy and property. But here is Pete unpacking all of that for us today. Cate Bakos, thanks for joining me back on Geared for Growth.
Mr. Mortlock, great to be back on the show. I think this might be my third appearance, over all the years you've been doing it. You'll have to check that one, do a fact check on it. But I've definitely done it at least twice, I think.
Well, I'll fact check you right away, because you're Geared for Growth podcast royalty, because you were episode 1 and we got you back for episode 100. The last time we had you on the show was a guest appearance with Cate Bakos for your new book. So this is at least the fourth one. And anyone watching on YouTube can see a copy of Pete's book, the Buy Right Guide to Property Investment. Let me get that right.
Yeah,
Buy Right approach
to property investing. Yes, you're absolutely right. We Cate and I jointly did an episode with you some time ago. So yes, I'm almost a regular. I should get a spot on the bench. So thanks for having me on. It's always great to chat.
Yeah, well, let's get you put straight to work as we do. There's a lot of things that I want to sort of chat with you about. Obviously, you're a buyer's agent, you're a finance guru, not necessarily you would call yourself an economist, but I think you're good enough for people to call you an economist as well. Let's start with the economy, and I guess the thing on everyone's mind is, okay, well, what's inflation doing at the moment, and when are we actually going to see some movement from the RBA on a downward trajectory? All of their rhetoric is kind of like, we're keeping our powder dry for an increase and don't expect any decreases, but the markets seem to be pricing it in a shorter time frame than the RBA's rhetoric. Where are we at with it?
Yeah, I think the really interesting thing is just how synchronized the whole global inflation trend has been. So if you went, say, back to 2018, 2019, all of the developed economies, USA, Canada, New Zealand, UK, Eurozone, Australia, very low inflation. Then we had the pandemic hit and nobody knew what the hell was happening. Inflation went to zero, in some cases even below zero. Then we had the massive stimulus and the lockdowns. And of course, that was always going to be an expensive exercise. And inflation went bananas. In the UK, it was over 11%. US was 9%. Australia didn't quite go as high, but we've stayed higher for longer. And so you've kind of seen this. It's been a really unusual shape if you were to look at it on a graph. But if you actually take a look at all the latest figures, so New Zealand, as we record this, actually had its inflation figures out today. Inflation came in a bit lower than expected, fell to 2.2%. So that's back to target for the first time since 2021. Canada's inflation rate is below target, 1.6%. So they'll be cutting 50 basis points next week as well. Eurozone, 1.8%. That's under target. UK figures aren't out yet, but they'll be under target for the first time in 3 years. So if you look at all these countries, and US the same, has been cutting interest rates. So Australia is not immune to that. We're probably just a little bit behind other countries. If you think about, we kept the borders closed for a little bit longer than some of those other countries that reopened sooner. And also the government spending has been pretty heavy. So we've been seeing quite a lot of jobs growth in NDIS and healthcare and government and public sector jobs. But everywhere else is seeing this inflation trend of inflation going from very high, near 10%, down to below 2%. And Australia, we're doing the same thing. We're just probably running a few months behind. And to your point, the next inflation figures in Australia released 30 October, so I don't know if this will have gone to air by then, but there's every chance that from November onwards, well, if inflation's no longer sticky in Australia, we could have live RBA meetings from November. Like, it feels to me like February is probably when we'll start seeing cuts, but if things start turning to custard sooner, then maybe before Christmas, so we'll have to wait and see.
I suppose it's easy to criticise the size of the stimulus package, but we didn't really know what the outcome would be. I think in hindsight we can go, yeah, we maybe overcooked it a little bit too much, but the government sort of acted very, very quickly, and there was all sorts of modelling about 30% unemployment rates that would be catastrophic for the country. But that stickiness of our inflation, you mentioned a couple of reasons, like the borders being open for a little bit longer. Little things like our international migration, I think our big pipeline of infrastructure projects around the country, some natural disasters, a big hike in insurance premiums on the back of that. Are those probably some of the key reasons why you think we are lagging a little bit behind, or we are fighting that inflation a bit harder?
Yeah, definitely. I mean, high immigration has been a big one. But don't forget, there was a period of time when if I were to go down to Mooloolaba beachfront, like every shop would have signs out saying staff wanted, we need chefs, we need waitresses, people to serve. Like some of those restaurants or cafes were looking for like half a dozen staff. There was nobody here, no backpackers, no visitor visas, international students weren't here. So we were always going to get a big snapback. You're right. There's a big stimulus. Infrastructure projects were a big one. The home builder stimulus saw this massive increase in detached house building, which is now dropping away again. And a lot of businesses are going insolvent actually because of the fixed price contracts they were tied into. But the thing is, it's always easy to sit on the sideline throwing stones. It's almost a national sport, right? You blame the government for its fiscal policy, and you blame the Reserve Bank for monetary policy. But as you said, if you went back to February, March 2020, I remember sitting here on a gated community in Noosa thinking, gee whiz, I'm glad we're on a gated community. The world could really turn to crap here, and nobody knew what was going to happen. The pandemic, it at first appeared it could be deadly serious. I think in the end it probably wasn't quite as bad as initially feared. But if you think about all of the range of possible outcomes that we might have had from all those months of lockdowns, like 9 months in Victoria, I guess we must be in the top decile of possible outcomes. We've got an unemployment rate of 4.2%, and inflation is notionally, if you look at some of the private measures, back to target. I mean, yes, of course, there would be things you'd do differently with hindsight, but I guess all things considered, and as you said, at one stage we were talking about 25% unemployment rates in the US, and people were talking about possible depression. I mean, it seems silly now, but at the time that was very real. So, yeah, I guess all things considered, things have panned out pretty well.
Oh, yeah, absolutely. And I think from a government that couldn't do like an online census or run like a gay marriage referendum for under $100 million, actually did pretty good with the stimulus packages for, business owners and those sorts of things.
There was one issue with the Excel spreadsheet where they collated the wrong column and 60 billion over.
Yeah.
As a chartered accountant, that's the sort of thing that brings me out in a cold sweat because they're but for the grace of God. But it shows you how quickly things were moving. There were huge numbers, eye-watering numbers being talked about in terms of the stimulus. But of course, Australia is quite lucky in that our government debt, or our net debt, is quite low. It's probably heading down towards sort of 20% over the course of the decade ahead. It's pretty low when you think about a lot of, for example, European countries where you're closer to 100 or even higher in some cases. So we do have a lot of firepower should it be needed. And I think there's been some interesting lessons. People talked a lot sort of pre-pandemic about wage price spirals, but in the real world, it seems to have worked the other way around. It's like prices go up and then wages follow. I think as well, what's been really noticeable is just how powerful fiscal policy can be. If you give people money, they will spend it. So a lot of this stuff, when you're looking at all the textbooks, nobody really thought about things like negative interest rates or these enormous stimulus packages or central banks buying up government bonds and things like that. It's been really interesting in a learning curve to see in practice. But yeah, all things considered, as I said, we've come out, or we're coming out the other side, relatively speaking, quite unscathed.
Mm. And talk to us about our economy more generally. How are we tracking, and what's the future looking on the sort of 2 to 5 year horizon?
Yeah, at the moment, we've been in what you would call a per capita recession over the past 18 months. So we mentioned we got this sort of hedonism trade when the economy reopened and everything sort of boomed back to life. But then monetary policy has been sort of winding that back over the past 18 months. So the economy might have grown by about 1% over the past year. But if you think about population growth, as you mentioned, that's been running at around 2.5%. So I guess in per capita terms, it's sort of gone backwards about 1.5%. But maybe that was inevitable. We had a real labour shortage. We needed to get people back into the country, and I mean, interest rates are doing what they should do, and that's slowing down consumer spending, just bringing the inflation rate back down towards the target level. I mean, I think at the moment we're probably going to see slow growth in the economy over the next 6 months, but eventually things will normalise and we can get back up and running again, so to speak. I think if you look at sort of forecasts for the next 5 years, we're back on sort of an even keel, I suppose, and inflation expected to be around the 2 to 3% target again. Growth back to sort of a healthy level. So I mean, I guess what we should have learned over the past 5 years is that things can always come along and change that. But at the moment, anyway, things seem to be normalising.
Yeah, excellent. Okay. And so you talked about wage price growth. We've seen, about a quarter of a century sort of high of wage price growth, and that sort of seems to have sort of existed with industrial relations, where we're seeing quite some generous packages sort of coming up that's driving inflation. Yet we're talking about this cost of living pressures. I mean, there's a tale of at least 2 or 3 stories. So I mean, how does the central bank sort of unpick this narrative? Because it does sort of seem like we are in this kind of per capita recession, as you say, but there still is quite a lot of consumption happening amongst the top end of town.
Yes, I mean, that's one thing. I've been traveling around the world a little bit last couple of months, and that's one thing that's been really noticeable is that while some mortgaged households are struggling and cutting back on expenditure, there's another cohort of people, particularly in the boomers or retirees, who have actually benefited a little bit from the higher interest rates, maybe more income on their fixed interest, and stock markets have boomed. So there's still quite a lot of expenditure or consumer spending up at that end of town. I think if you look at wages growth, yes, you're right. During the mining boom, we got this big sort of spike or surge in incomes. I remember in some roles turning up to work and getting a bonus just for showing up sometimes, or you get a pay rise just for to try and retain staff. Well, yeah, we had a long period of time, probably from the peak of the mining boom, 2012, through to, nearly a decade's worth of pretty lackluster wages growth. And I think just through the pandemic, the combination of the real shortage of labour, that pushed up incomes in things like retail and hospitality and so on. But also, because we had such high rates of inflation for a couple of years there, a lot of award wages would be in some way benchmarked to the inflation rate. So prices went up. Then, of course, unions and negotiators want higher pay. So it does seem though that we're probably past the peak of the wage price growth. I think it probably peaked in the December 2023 quarter, and we're coming back down the other side now. So again, I think there was a period there where there was some concern that if wages keep going up and then prices keep going up, you get into this self-fulfilling upward spiral. But it seems to be, again, normalizing now. Unemployment rate was as low as, it was under 3.5% at one stage, but now it's on the way back up, getting back towards a sort of more sort of normal level or non-accelerating inflation rate. So I think, it was good in some ways for workers at various points in time. But of course, the cost of living has gone up as well.
Yeah. And I want to ask you about productivity, because we've seen an increase in wages. And of course, if you have an unemployment rate of 3.5%, obviously that puts quite a bit of pressure on it. And that led to crazy levels of international migration, which I'll unpack in a minute. But I can remember a lot of commentators saying with OpenAI and ChatGPT that this is the greatest productivity boost since the Industrial Revolution, and perhaps to a factor of 10x. What is the problem with productivity in the country? And do you think that is the panacea, that we're going to be able to use these large language models to augment our capacity?
Well, look, maybe going forward, but it hasn't happened yet. I think this has been a very unusual 3 or 4 years. So it's not like you can look back to a previous cycle or a previous time and say, oh, well, you lock down the economy for a year and see what happens. There's nothing that we can easily go back and benchmark against. We did see in 2023 a massive surge in the number of hours worked, but it didn't seem to, at least, result in the same increase in output. So, a lot of discussion about productivity. One of the big discussions that's sort of been percolating around in housing market circles is the return to office. So, Australia, they've seen some firms, have we seen in recent weeks, Dell and a couple of others saying, right, people have got to go back into the office 5 days. I think some of the banks have been pushing for it. Look, there's two sides to that argument, isn't there? Some people might not be as productive working at home, but by the same token, if they're spending 10 hours a week sort of driving to and from the office, then that's not particularly great for productivity either. So, I think looking forward, yes, tech and AI and some of those massive improvements in technological capability, there's some real potential improvements to productivity, but it's not really happened yet. And I think we're still feeling a bit of a hangover, I guess, from the pandemic period.
Let's get on to international migration, because as you say, you go down to Mooloolaba, everyone's looking for a barista or to wait tables or a chef. I mean, the government really was sort of forced into a position where we needed international migrants because, the economy needs a certain level of spare capacity. I mean, you could sort of be forgiven for thinking, well, isn't the goal like a 0% unemployment rate? But that's actually quite an unfunctional or a non-functioning economy. There's been a lot of pressure on the Labor government to cap migration. We saw that probably start in the December quarter. And of course, it's all about the lead up to the next election. We've seen caps to student migration. So that's got the universities up in arms about having to make cuts. And that has an influence on some particular pockets of the property market. So can you give us your broad assessment of where we're at with migration, how well it's been handled, and how that's kind of influencing the property market?
I think there was a sense of inevitability about this. So, if you looked at the population clock today in Australia, it's about 27.4 million, maybe a bit higher. So that's an estimate of how many people are in the resident population in the country. If you went back to 2019, it's not really, it's kind of on trend. It's what we would have expected. But of course, what happened in the real world is when the lockdowns happened, the border closures, Australia's temporary visa holder numbers went from about 2.4 million to something like 1.6. Or we lost 750,000 people. International students weren't here. Temporary sort of visitors weren't here. So working holiday visas, and no backpackers to do all those kind of jobs, which they often do. So I went for a coffee this morning. Places in Noosa, of course, you're served endlessly by backpackers, people on 12-month working holiday visas. So a part of what has happened has just been a snapback. So when the international students could come back and when working holiday visa makers felt able to come back and they could afford it, the number of temporary entrants on visa holders is now 2.75 million. So it's a lot higher now actually than it was pre-COVID when it was about 2.3. It's probably on trend for what you would have expected. But we kind of lost 800,000 people, and it's come blaring back. It's gone. We've added over 1 million temporary visas, and I think so that was probably needed. I think year-on-year population growth will naturally fall back to a sort of more normal level. I think some of this has been driven by a base effect. But in certain parts of the country, particularly Western Australia, Southeast Queensland, it's putting a lot of pressure on housing, infrastructure. A lot of people moved regionally, I suppose, in recent years as well. So some markets have seen that the change in demand has happened much faster than supply can respond, and it's just putting a lot of pressure on stuff. So, yeah, I mean, it's easy to, again, sort of point the finger at the government, but what were they supposed to do? We had a record low, or the lowest unemployment rate in decades and decades, and real pressure on businesses to try and find workers. So we were always going to get a snapback. I guess now they sort of need to be seen to be doing something, and that's hence the sort of changes around student caps being proposed.
Now, the One Nation-esque style commentators would be able to point to, say, international migration as the reason why our vacancy rate is so tight, but there's a myriad of factors that we need to sort of think about. It's the property investors selling. Maybe they were just cashing in their gains, but I think there's been a lot of tinkering around the margins with state legislation that has made people sell. International migration, we know sort of from the data that typically these people will rent for a period of time before they buy. But we keep hearing about this supply, and the government's wanting that 1.2 million homes to be built in 5 years. Already it seems like it's over before it's even begun. The vacancy rate just tipped back, I think, yesterday to 1.2 from 1.3. A balanced market, we've always kind of talked about being 2 to 3%. I mean, where is the government getting it wrong on that, or is it just a matter of supply and they need to try and find ways to loosen this up?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, I mean, there's definitely a market cycle component to this. I think if you look at the national rental vacancy rate of 1.2%, that's about 38,000 rental vacancies. It's not much. If you think about in the December quarter, for example, we'll get an extra 300,000 visitors into the country. So the hotels are going to be tight. Airbnbs will be full. If you look at where the declines are being driven, Perth, Canberra, Hobart, regional Australia. So Brisbane CBD is really tight. I'm not sure that the rental vacancy rate will go much lower because generally what has been happening is that people bunch up. When the rental market is really tight, you're more inclined to stay at home with parents for longer, or maybe you buddy up and you sort of rent a place jointly. So the rental vacancy rate might not go much lower. But if you look at CBRE's outlook for the next 5 years, there's not really an improvement in this because population growth is still expected to be strong. The supply, it takes time to deliver. Medium density units, probably take 3 years from start to finish to get delivered to the market. And commencements are way off the high. They're down about 40%, I suppose, for medium density. So it's going to take a few years at least for this to be tackled. But I think it's just a combination. Interest rates are much higher than they were, and construction costs for a medium density project are probably 50% higher than where they were in 2019. So there's stacks of markets where unit prices haven't moved much in 5 or 6 years, and nobody's going to build. The profit margins just aren't there at the moment.
I wasn't in attendance, but I did watch remotely a Real Estate Institute of Queensland breakfast that you presented at, and you were kind of asked the question about vacancies, or it was probably the growth of rents, and you basically sort of said there's nothing in the fundamentals that say that the pace of growth should drop, but behaviour will drop because people can't get to a certain level, like they're not going to be paying a median of $4,000 a week in rent, people will change their behaviour. And I think we've seen a decrease in the pace of growth of rents, still very high and still, up around double digits in a lot of places. But, that was a modest amount if you look back kind of a year ago. But it certainly seems to be the case anecdotally, like places like flatmates.com.au are changing their branding to not be sort of uni students. It's actually middle-aged people that are wanting to find a location. Are we seeing that evidence yet in the household formation rate, or is that from an ABS data point that takes a little bit of a time to come to market?
Yeah, so I mean, look, it's very broad brush, but if you take a look at the estimated number of dwellings divided by the estimated resident population, or I should say the other way around, I mean, that's been in a kind of a long sweeping downtrend over recent decades. But at the low point during the pandemic, when there was this kind of race for space, and a lot of people had second homes, they were going to the coastal markets, we saw a record low in terms of the average household size. But it does seem now that we're past the bottom and the numbers are on the way back up again. So that sort of suggests that, the very tight rental markets are changing behaviours, and more people sharing now. Or I think as well, a lot of clients who come to us, people are renting and they're like, this sucks. If I can get a deposit, I'm just going to become a home buyer. And it's just sort of changing the dynamic. So rental price growth, CBRE are forecasting 25% over the next 5 years nationally, which is quite a lot, actually, when you think about it, per annum. But we're probably past the peak of this sort of real surge in rents. There was a period there where rents were up big double digits. And from an inflation point of view, we're probably beyond the peak. But the problem hasn't really gone away. It's just sort of morphed a little bit. And more people sort of buddying up, I guess.
It definitely hasn't gone away. And of course, it's going to be one of those key election kind of battlegrounds. And we already saw some Labor member leaking the fact that Treasury were modelling negative gearing changes, CGT changes. I've actually had three journalists commenting, asking for my commentary on negatively geared and CGT positions from the PM. Firstly, his investment property in Dulwich Hill that was for sale, what would the negative gearing position be? Then it was like, okay, well, if he sells it for this, what capital gains tax would he have to pay and what sort of exemption is there? And yesterday he's bought an investment property in the Central Coast that might end up being an owner-occupier for him later on. But I was asked to model, well, what would the negative geared position be of this $4.3 million property that rents for $1,500 a week? And spoiler alert, it's massive, right? So I'm not exactly sure what their angle is, but it's either got to be something like, well, he's maybe going to turn the tap off, but look at all the stuff that he's claimed, or look at how bad it is. I mean, the Prime Minister himself is such a beneficiary of this. Do you think they're sort of barking up the wrong tree in terms of trying to solve this rental affordability crisis by looking at CGT and negative gearing?
Yeah, that's such a non-story, isn't it? Surely the Prime Minister's allowed to buy a property if they want. This was a thing in the United Kingdom on the progressive side of politics, because Tony Blair had houses all around the country and some very upmarket suburbs in London. So people were saying it's not a very Labour sort of set of optics to have somebody with a property portfolio in the tens of millions of pounds. But yeah, I mean, at the end of the day, he's the Prime Minister. He should be allowed to buy a home. I think what's happening, if you look at, so the PM had previously said he'd never lost a news poll, but that has actually now changed. So in the last week or so, there was the first news poll that actually put the opposition ahead on a two-party preferred basis. So I think in turn what that does is it makes the possibility of a minority government actually in turn higher. And therefore, there's going to be potentially more influence from, for example, the Green Party. And the Greens are pushing for reforms to negative gearing, capital gains tax. They want a rental price freeze to tackle the rental crisis, at least temporarily. The Labour Party is sort of more keen on taking its Housing Australia Future Fund policy to the election, plus the Help to Buy model. And the opposition is more interested in early access to superannuation for first-time buyers up to a $50,000 cap. So, yeah, it looks to me like, I mean, obviously things can change, but the trajectory or the direction of travel is that we could end up with Labour winning, but with a minority government, in which case potentially some other parties might have more influence on policy, and hence sort of the modelling on negative gearing impact and so on. Look, when most economists have modelled this, I mean, the Peter Tulip and others have done modelling on negative gearing and CGT. It's probably not the biggest determinant of prices. And the Housing Industry Association has often said you can't make housing cheaper by taxing it more, So, I think it would have an impact for sure. And it would certainly change rental yields. I think they would have to snap higher one way or another, whether that's through rents or through prices, if there were to be reforms to negative gearing. But yeah, don't forget the Labour Party lost the 2019 election pretty much on a range of very similar reforms. So I'm not sure they'll be rushing headlong into a housing election in the same way in May 2025.
Well, 2 elections, I guess you could probably say as well, couldn't you?
Queensland election today, actually. I've got to nip off and post my vote early today. I've been in Australia since the 1990s. I still don't understand how it all works. You just write a load of numbers on various slips of paper and hope that somebody decodes it. But I think we're due actually a state election change of party if the early polling's anything to go by. But I think, at the national level, I think the federal level, look, anything could happen, but it looks more like a minority government next time around.
In terms of the property market, I guess everyone's focus is on the Reserve Bank, and maybe we get a Melbourne Cup Day cut, or we might get a February cut, as you suggest could be the case. But what are the implications for the property market? Does it sort of seem clear that any kind of cut will increase the budget of property investors or property owners, just gives them that little extra bit? I mean, it might coincide with a change to the interest rate serviceability buffer. Does a decrease in the interest rate automatically mean forward territory for property?
Yeah, probably. I think so. I mean, to some degree, I think investors are getting in ahead of this. If you look at it's a weird kind of two-speed market, because lots of investors are selling up, particularly in Victoria, because of land taxes and holding costs have really sort of blown out. But on the other hand, if you look at monthly lending figures for investors, close to 11 billion last month. It's almost back to a record high, and it's 34% higher year on year. So even though there's a lot of investors selling up, there's lots of investors coming into the market as well. So yeah, I think if you lower the cost of capital, generally that would result in a spike in activity, but it wouldn't be the same everywhere. I guess it could be akin to pouring kerosene on the market in Perth, for example. But Victoria's been sort of in a flat or falling market for nearly a year now. So maybe it might just be a sort of change in sentiment down there. So yeah, it depends really where and which parts of the market. But certainly it would be a positive for sentiment, I would think.
Let's talk about Perth, because you mentioned it, and everyone is talking about Perth because it's leading the race. I think in the last data print, it sort of showed its first little bit of weakness, but it's hard to say, 1% plus growth in a month is weak. I mean, we're talking about annualized growth rate of near on thereabouts 25%. What is peculiar about Perth to you when you look at the data? I mean, even today, it sort of seems to have fairly solid affordability metrics. When we talk about the last federal budget, I mean, it surprised on the upside with a surplus. Really, it seemed to be because unemployment was a lot lower than expected, but mostly what they had predicted for materials, let's say coal, coking and thermal coal, was a lot lower than what the actual market was. Is there a correlation between that and the Perth property market? And how would you unpack what's happened in that gold rush over there?
Yeah, great. That's a good analogy, actually. The gold rush, it is a bit like that, isn't it? I mean, if you were to take a look at the Reserve Bank's index of commodity prices for Australia, it basically meandered along at a very low level for decades. And then I guess around... when did it really get going? About 2004, I suppose. And so bear in mind, I was working at Deloitte back in the day. And every year, Deloitte used to put out this piece saying, mining boom is going to peak. And then it was like 2004, 2005, 2000, it just like became a bit of a running joke. But commodity prices, obviously there was a wobble through the global financial crisis, but then China poured stimulus onto its market. Iron ore prices went sky high. Demand for everything, copper, gold, coking coal,
the rare earth as well,
metallurgical coal. Yeah, it just all went bananas. And obviously for Perth, that was boom years. And I was working in the mining industry myself through the mining boom because you could earn double, So yeah, obviously the population growth in Perth went to 3.5%. The supply could never keep up. Prices tripled in, 8 years or 9 years or something. It was a full-scale property boom. But then I suppose since 2013, there's not been much for Perth, until relatively recently. And again, it was really the COVID stimulus that saw the Reserve Bank's index of commodity prices. So the commodities that really matter for Australia, again, went more or less vertical. Coal in particular was in massive demand, but also, iron ore, copper, gold, silver, you name it. So again, that's sort of teed off another a cycle for Perth. And I think people had been so disappointed for so long by housing prices in Perth. People have been sort of intrepid to begin with, but once prices started rising, vacancy rates fell to almost zero. Population growth's been running at 3.5% again. So we've gone from sort of this overhang of or oversupply of property in 2014-15 to suddenly just not enough housing. So I was actually over in Perth not so long ago. It's a great city, I love it, but it's quite sort of remote and it works to its own cycle, really. Mining is a huge part of the economy, so it's very pro-cyclical for the housing market. I love the place, but it's just a very long way for anyone trying to run an East Coast business. Main appeal for me is I could fly direct to Heathrow now in 17 and a half hours, which is pretty cool. But look, in terms of how long it goes for, more interest rate cuts will be more fuel on the fire. Vacancy rates are still very, very low. It doesn't have the affordability advantage anymore. So for a while, Perth was the cheapest mainland capital city in Australia. That's not the case anymore. Prices are up, 80% or something in 3 or 4 years. So, I think it's, the cycle will probably keep going just due to the sheer shortage of housing. But it's really a case of caveat emptor. You need to be prepared, if you're an investor today, to hold for 10 years plus. Try to stick to the parts of the economy that are a bit diversified. You don't want to be going out to sort of one industry towns or things like that, where when the tide turns, it could be brutal. And you just have to go in with your eyes open. But when I was there, what was really noticeable is that yes, they are building some houses in suburbia, and that's starting to pick up quite nicely now. But there's no units being built at all. It's just projects just aren't stacking up. So the supply shortage is going to take quite a while to be addressed by the looks of it.
So I mean, your point about a 10-year time horizon, we know with Perth it really had about 14 years of zero median house price growth, admittedly on the back of a boom, and there's probably a peak in the middle. But the buyer beware, caveat emptor, I think is it's a pretty strong sentiment that most people would have on Perth right now. But do you still think, based on some of those shortages, it still has a bit to run just yet?
Oh yeah, for sure. Yeah, in fact, it's interesting you mentioned there that kind of the lull in the middle, because you could almost overlay a graph of commodity prices onto the Perth housing market. It would be like a perfect match almost. On that point, commodity prices have started to come back down now quite significantly. So looking forward, it does mean we will reach a peak for Perth eventually. But vacancy rate's 0.6%. It's nowhere near keeping pace with what's needed. And if interest rates, market pricing is for 4 cuts over the next 12 to 18 months. So that probably brings more investors in. I think, this is something that gets talked about quite a bit in the industry, is that there's a lot more buyer's agents in the market now. And they tend to sort of everybody in together, everybody out together. And that will probably amplify the cycle as well, because every buyer's agent wants to be able to say to their clients, 25% growth over the past year. But as we know, properties, it's not really a 1 year investment. You do need to think about the sort of 5 and the 10 year outcomes as well, which might lead you more towards Melbourne, for example.
And I guess when people talk about Perth, it's kind of like the peak of the market. Melbourne is the bottom of the market, and people are always looking for that next Perth. And there's quite a few people suggesting that, well, it could be in Victoria. But then I've also seen on the property market say, people looking at Darwin. Look at Darwin, like everything else has gone up, so it's got to be next. And what I really take issue with the gotta be next. Like it has to go up next. I mean, I'd be interested to hear your thoughts on that sentiment and how bewitching this idea of like a mean reversion is, but it doesn't necessarily sort of mirror reality.
Yeah, it's interesting because I guess we're all the product of our environment, and I was somebody who grew up in Britain where we have really gone in for the boom bust economy, not just in recent years. This is going back to the 80s, the early 90s recession, global financial crisis, you had the tech bubble. And yeah, I guess you get somewhat scarred by some of these outcomes because I've seen regional markets where we've had sky high unemployment, house prices have gone backwards for years, if not decades. I even was born in one of those cities. So yeah, like that has always sort of led me towards to look towards the sort of bigger towns and cities because I've seen particularly the one industry cities or regions what can happen. But in Australia, we've been, yes, some of the mining towns got clobbered in 2013, I suppose, around then. But generally speaking, the cities, normally what seems to have happened is the cheapest city then booms. So if you think about Hobart a decade ago, then Adelaide had its time in the sun, then Brizzy, and then, and so on. So I guess on that logic, yes, you would say that Darwin is probably due. I mean, it's a funny city, Darwin. I used to live there years back, back in the sort of glory days of mining. And again, it's very much like everybody either works in mining or for the government. There's not much else going on, really. So, vacancy rates are low. They really don't build many apartments in Darwin. And it's a very small market, so a relatively small shift in the number of buyers could actually see prices go vertical. That could happen, and it was a bit like that when I lived there. Every second house had a brand new Prado. There was full employment, but yeah, they tend to be more cyclical markets, so you just need to be a bit careful with that.
So when it comes to the Next Perth, I mean, is that something that you would kind of rage against? Because as you said, an investor needs to invest for more than just that first 12 months where they might be able to get 10 or 20 or 30% growth. Are you looking personally and with your business for the Next Perth, or are you more focused on the long-term fundamentals rather than these sort of sugar hits?
Look, there's many ways to skin a cat. Like in my personal case, I do a bit of both. I've got some long-term assets I'm just never going to sell because I would never be able to afford to get back into those markets again. So I've got just some core assets where I just think about long-term fundamentals. So I've got a place at Darling Harbour. I'll never be able to borrow enough money to buy there again. We've got some houses in sort of top markets in UK. They're not properties to sell, but on the other hand, sometimes there is a market timing thing. And one of the things that I've done a little bit over the past decade is look for the most out of favour market you can imagine, which at one stage was Geelong, another time it was units in Brisbane, and you can pick up stuff really cheap when everyone's got a downer on it. So there's different ways to do it. You can have some long-term holds and some things to trade. I would say, if you're looking for real deep value at the moment, probably office space is probably where it's at. And we're actively having a look around for an office to buy. In terms of the next the Next Perth, well, yeah, there's you just have to follow what the buyer's agents are doing because it's almost becoming a self-fulfilling prophecy now with the number of people going in. Like Townsville is a good example at the moment; it's going ballistic. So, I guess, but you do need to be careful because in some of those markets they're a bit less liquid, and if you need to sell, it might not be quite so easy.
Yeah, absolutely. Well, Pete, we better drop you off so that you go and vote for your new party in Queensland. But are there any other thoughts or insights you want to leave with us about the general economy or property markets?
No, I mean it's we most of what we do is in southeast Queensland. I think Brisbane is still pumping along. Sunshine Coast is a bit. Things have calmed down quite a lot. I think you got a big influx of people through the pandemic, but we're starting to see some decent value there. Gold Coast the same in certain pockets anyway. And also we're doing quite a lot of stuff down in the favourite parts of the world of yours, Newcastle, Central Coast, those kind of markets. We're pretty active down there as well. So yeah I think it's we try to really focus on 10 to 20 year investments, and we don't get too caught up in the hype of the latest cycle. We just try and stick to fundamentals, and a lot of the stuff's common sense, really. Landlocked suburbs, good school zones, good houses, that kind of thing.
That's really what I suppose drew me to you in the beginning. Is a lot of the things that you say are just common sense things. Things like spend less than you earn and invest the difference. And if you've got leverage and you've got compound and you've got time, then there's all the ingredients that you need to create wealth. So it's hard to stand out when you've got such simple messaging, but I think you've been able to do that very, very well. So thank you for keeping us on the straight and narrow, and thanks for sharing all of your wisdom today.
Yeah, pleasure. Yeah, it can be simple, but not easy, as they say. But you'll usually find if you stick to the fundamentals, try and do the right thing, work hard at the right times, and you'll probably find the long-term results are just fine.
Beautiful. Thanks, Pete. We'll see you next time.
Pleasure. Thanks, Mike.